A very good afternoon, good morning. Welcome to HYCM's workshop with myself, Giles Coughlin, a Chief Currency Analyst. Hope everybody's doing well. Looking forward to taking us through the session. If you just let me know you can see my screen and hear my voice okay, that's always a reassurance that I'm coming through okay. Everything seems all right my end. Other thing I want to say is, just as we get going, just going to pop the disclaimer up, is don't forget any entries, exits, any different instruments we look at. This is not trading advice. The whole idea is you look over my shoulder, someone with a professional trading background, and you can see how I go about making trading decisions. It's not a signal trading service. Those of us who are regular, you know, the regular guys and girls, we know the score. But those of you who are just joined, thank you, Warren. Voice and clear and screen shared, all okay. That's excellent. Very good. Right, now let's, okay, that's great. Okay.
I was just given it's got a geopolitical slant.
Without further ado, let's get stuck straight into the session. And what I want to look at is I want to show us a potential opportunity that they're setting up in the New Zealand dollar Japanese yen. Now, the catalyst for this being a definitely good trade would be if we get some positive Omicron variant news. We will look at that in a little bit more detail during the session. But otherwise, what we'll be looking at now, just bring it to my other screen. What we'll be looking at now is the New Zealand dollar Japanese yen pair from a seasonal perspective. We're going to look at it from a perspective of central bank policy, and then we're going to be looking at it in terms of what's happening right now with the Omicron variant. Now, if you just take a look at the latest, some of the latest headlines on the Omicron variant, there's been, like, I was just sort of noticing on my Twitter feed just before this webinar, actually, another World Health Organization headline broke. No evidence so far that vaccines have less efficacy due to Omicron variant. The market is absolutely fixated on this. The news of the Omicron variant broke over the Thursday Thanksgiving of last week, when many US investors and traders were away. That resulted in heavy risk-off markets. We saw the VIX surge higher. We saw equity futures markets drop significantly lower. We saw significant downside in the risk currency pairs. Let me just show you. You take a look at the risk sensitive pairs here. What you see, this heavy selling has come into the market as you see the very typical reaction, which is yen strength, Swiss franc strength in risk off markets. That's what the heavy selling has been. Now, we're seeing a little bit of retracement. Notice there's a false break of Harami inside bar CAD yen, false break of Harami inside bar New Zealand dollar Japanese yen. We're seeing false break of Harami inside bar in the Aussie yen. So we're seeing a little bit of retracement higher because increasingly there is no bad news or very little bad news about the vaccine efficacy against Omicron variant. Now, the one headline we need to look for is this. If we get a headline from Pfizer, Moderna, Johnson & Johnson, I had a list of them out yesterday, and these are here. I just put this out on my tweet. Moderna, Pfizer, Johnson & Johnson. If you get one of those big companies saying, you know, we've done our preliminary tests and the Moderna vaccine or the Pfizer vaccine is, you know, 80% effective against Omicron variant and prevents all serious disease. If you get something like that, expect these risk-sensitive currency pairs to rapidly retrace, and it would be a buying at market. Now, the pair I'd like to look at in particular is New Zealand dollar Japanese yen. Now, if you look at the bond yield spread between New Zealand and Japanese yen, do you see how price tracks the bond yield spread very carefully? Now, can you see at the moment, now what is the bond yield spread? It's simply a risk proxy for which country is expected to do better than the other. So as the bond yield spread moves higher, what it means is that the 10-year bond from New Zealand yield is rising more quickly than the Japanese 10-year bond. Now we know the Japanese 10-year bond is undergoing yield curve control. It's got to sit at that 0.10% level. So what this does, it just shows us what expectations are for the New Zealand economy. Now, if you look at my blog, which is almost exclusively, the content is almost exclusively mine here on the HYCM blog. There's only a few kind of market basics, articles that I don't do. All the analysis, that's all mine, and it's always updated. And you can see here that in the last Central Bank Watch, 26th of November, I wrote an article about the RBNZ. Dovish hike, but revising growth higher. And what I kind of was drawing to our attention was that the outlook for growth in New Zealand, have a look at that data yourself. The outlook for growth has significantly been revised higher. Now I'm going to see if I can find an easier way of demonstrating this to you. But I think I've got a screenshot somewhere of this. Let me just pull it up from my other chart. Yeah, this sums it up very nicely. Now, the data on the left is the economic projections from the central bank meeting before last. This table on the right is the economic projections for the last RBNZ meeting. Now, if you notice, look how much inflation. It's 3.7 2022. It's now gone up to 5.7. That's bullish. 2.2 to now 2.9. So yes, they expect inflation to be transitory, but they expect it to be a bit higher. Look at the trade-weighted index. They're expecting the trade-weighted index to move higher. So they're expecting growth. Look at the GDP revised from 5.9 to 2.4. Now, yes, it is revised lower for 2022, but notice that 2023 is revised higher. So on balance, GDP is revised higher. Labour market, unemployment, look, it's expected to go right down to 3.3. That is fantastic. And finally, look at the interest rate projection. Do you see here the interest rate projection for 2022? Interest rate is expected 1.6%. It's currently 0.75%. So in 2022, it's now expected to be in December 2.1%. The 2024 projection was 2.1% for March of 2024. That's now been brought forward into December 2023, so 1 quarter earlier, and raised up 50 basis points. So you got 50 basis points increase and a sooner rate hike up to 2.6%. So now you can clearly see the evidence for why the outlook for the New Zealand dollar looks good. And despite this, look at this weakness we've been having. So that means any retracements down to the 75 level offer exceptional good value. If we have some positive Omicron variant news, like today or tomorrow or next week, expect buyers at market in the New Zealand dollar, Japanese yen. The yield spread is high, so you'd expect price to move back up to that yield spread. Get back above that 78.50. That is a key weekly trend line. Then we're looking at retesting up to 81.50 and 8200. So there's low risk, high reward, a near-term place to enter. You see, you've got a Harami inside bar pattern. You can enter at market with stops below 76.50, looking for a potential play up to 82. That is the monetary condition outlook. Now let me just quickly show you the seasonal outlook. It's pretty hot when we look at this seasonally. Now don't forget, if you're an HYCM client, which you are, you all have access to this. Just speak to your account manager and you can get access to SeasonX, and you can search like 25,000 different instruments, indices, commodities, currency pairs, individual stocks even. It's a fantastic tool and really highlights some strong patterns. And there's some tax loss selling behavior which weakens the yen around this time of year. And look at it. Do you see from the 1st of December to the 31st of December, the New Zealand dollar Japanese yen pair has risen 13 times out of 15 times. Okay, and if you just look in the last 21 years, it's risen 16 times out of 15 times. Only two major losses, 2005, 2018. So statistically, probability-wise, New Zealand dollar yen is set for higher prices during this month. Right, so now, what's the risk? There's always a risk to every outlook. Now, risk to this outlook is obvious. If the Omicron variant is vaccine resistant, that will be bad news for markets. We expect the yen to keep strengthening. We'd expect the New Zealand dollar to keep falling. Look out for that news. It would be bad news. The other aspect is if we saw, a much faster than expected interest rate hike cycle from the US, that could potentially weigh on stocks. And if stocks fall quick enough and fast enough, that could weigh on overall risk sentiment. So they're the two key risks that I can see sort of knocking around markets at the moment. But that's that's definitely a key market risk to be looking at. So if you haven't been considering New Zealand dollar Japanese yen, do have a look at it. And don't forget as well, also worth being aware of, not necessarily for a trade, is the Aussie yen. Now the Aussie yen, again, you notice how it's just sort of putting in that, see this level 1, 2, 3, that's close enough. You see we had this retest of this. Always extend your trend lines out past price. With your trend lines, never do your trend lines like this. Always extend them out past price because they invariably become useful again. Price moving into support. We've got the RBA meeting next week. So if we got some positive vaccine resistant news, positive Omicron variant news, and we got a good Reserve Bank of Australia meeting next week that maybe starts to turn a little bit more hawkish. We're neutral the Australian dollar at the moment because it's like been a very bearish story. We feel we're past peak bearishness. The Aussie is going to be very sensitive to good news now. If we get some good news with the Aussie dollar to move higher, but also keep an eye on these two markets. So keep an eye on iron ore futures and coal futures. So you can see at the moment with coal prices dropping, iron ore prices rising, the kind of, the midway point, which are the two, we're seeing that this negative pressure moving to the downside. That's a negative for the Aussie dollar right now. If we saw coal futures moving higher again and iron ore prices moving higher again, we'd expect that to lift the terms of trade for Australia. About sort of, a quarter of all Australia's exports are iron ore. So that recent drop in iron ore prices has been weighing on the Aussie, but the recent surge higher in coal prices has been helping the Aussie. I think it's about 18% of Australia's economy is driven by coal. So between coal and iron ore, what they're doing is important. At the moment, iron ore is showing a little bit of a pick up, but coal futures are dropping sharply lower. So just keep that in mind. But that is another market to be aware of ahead of the Reserve Bank of Australia. And again, any very positive news, expect that to boost. Don't forget as well, the Australian dollar, if you're trading that, any Chinese data is important. China is Australia's biggest export market. So anything that's good for China lifts the Australian dollar because of the very close trade relationships there are between the two nations. So with that being said, now let's look at what's going on with the dollar. Now, the dollar is important right now. And we can see the dollar just holding above that support level. Now, yesterday, we saw the dollar find some bids, and that was for a very specific reason. The dollar found bids coming in here from 95.50 after Jerome Powell gave a strong indication and confirmed that the Fed are going to have to be tapering more quickly. Fed's Clarida, Fed's Daily had hinted and expressed that the Fed would be raising interest rates more quickly. Now, Jerome Powell pretty much he confirmed that. Now, that's why the dollar strengthened. That's also what caused gold to sell off yesterday. Now, we've got to be careful here, because what that means now, I'll just show you the Fed Fund Futures. Now, this is the Fed Fund Futures chart. Oh, sorry, wrong one. This is the Fed Fund Futures chart, rather. And you can see here that prior to the Omicron variant, there were 3 interest rate hikes expected from the Fed for next year. Now, we had the Omicron variant fears, and everyone thought, oh no, that's going to make the Fed pause. And we saw 10-year yields move lower, so the dollar moved lower. Now, we're seeing a little bit of respite. One, there's a bit of absence of bad news about the Omicron variant. But 2, most importantly, Jerome Powell indicates the Fed is going to have to taper more quickly. So now we're seeing interest rate hikes being priced back in. It's nearly back up to 3 interest rate hikes being priced in for next year. Now, that has meant the dollar has been seeing some bids, but we're quite close to peak bullishness for the dollar. A lot of this good news has been priced in, and don't forget that the dollar yen, for instance, is totally pushed and pulled around by what happens with US 10-year yields. So you can see how closely the dollar yen moves in line with 10-year yields. So this is basically expectations of what the Federal Reserve is going to do. 10-year yields pushed higher yesterday because Jerome Powell indicated that the Fed would be tapering more quickly. So we've got some pressure to the upside. Now, this means that with the data we have currently being released, and if you just take a look here, there's a lot of data, US data, but this is not going to be important now unless it's outside maximum and minimum expectations. So look at the ADP data and the ISM data up next. Now, if the ADP data, now the ADP data is employment, national employment. Now, it's not very good at predicting what happens for non-farm payroll on Friday, but it does set the mood. So this is what you want to look for. If you see below minimum expectations and below minimum expectation for the ISM manufacturing PMI, that sets up expectations that maybe the Fed got it wrong. And if the NFP is very weak on Friday, that sets up expectations that the Fed is very wrong. And that, that will mean the following. Gold would move higher, 10-year yields would move lower, dollar yen would move lower. So what you want to look for in that environment is if we get below minimum expectations, and look, minimum expectations below 340, and below 60.8, expect 10-year yields to drop lower and gold to surge higher in the near term. Okay, that's what you want to be looking for. And gold's at this very interesting area, just leading up against that trend line. We've got some mixed technical signals. If you look at this, we've got Harami inside bar false break indicating higher prices. Prices moved higher and sold off. We've got Harami inside bar false break indicating lower prices. So we've got a bullish signal, a bearish signal on a large chart. This tells me there's some big explosive moves. It's a two-way market here, okay? So that's what we're doing. Yeah, now Josh asks, how do you tell when it's peak bullishness? Oftentimes, Josh, it's when the markets have been in one particular direction for an extended period of time. So I'll just give you our currency research for the week. Now, this is, have a quick screenshot of this, Josh, and it will help you understand where this peak bullishness comes in. Because what you've got to think to yourself is the Fed really going to hike interest rates 3 times next year? Okay, take a look at this, and you can see that the markets are really getting quite aggressive. Will they really hike 3 times, June, September, and December? That does seem aggressively priced into the max. And then if you look here, you can see all the different variables that can weigh on the US dollar. And also, if you look at the positioning aspect, if we have, lots of surprises to the upside, if we have, RBNZ revising growth higher, Bank of England revising growth higher, then that's all positive for US dollar weakness. So have a look at that, okay? Now, obviously, shorting this with the COVID news was a no-brainer trade, right? But now that trade's gone. Yeah, that move lower in dollar has gone. Okay, we've moved into support. Profit is taken by most people who are short the dollar yen, and that's it, right? And now we're reassessing. And we've got to reassess because we want to find out what's going on in the medium term, right? But I hope that helps, Josh, just to give you a little bit of a heads up there. Now, what this means for gold is any the market is very sensitive to any bad news for the US. Any good news, yeah, we might see the gold keep drifting low on the stronger dollar. Okay, but the best opportunity would be if it's very bad news. We expect gold to surge higher. I sold gold out of the event yesterday, selling it just under 1800 as the news came out that Jerome Powell was looking at confirming that fast taper. Faster taper means interest rates are coming. That means dollar strength. It means gold downside. It was a no-brainer trade, right? So we're now into the next stage, looking for the ADP data, looking for the ISM manufacturing data. Remember, manufacturing is about sort of 20% of the US economy. The rest of it is services. So manufacturing PMI is less important than services, but got non-farm payroll on Friday. So that could be a big one. The Fed's blackout period starts on Saturday. So as of Saturday, the Fed won't be giving any more communication. So the non-farm payroll is the last taste in the mouth, if you like, about what the Fed are going to do for in 2 weeks' time. So that's one opportunity. Oil is this is all about demand. The reason oil's been moving, this is the OVX, which is the volatility in the oil chart, and you can see that the OVX has pushed up to highs last seen about April, March 2020. The time when, the worst COVID-19 time when oil went down into negative territory. So what that means for oil is that markets are very volatile. If we start to see OVX moving lower, if we see that price that dropping, that's the sort of thing we want to see for more upside in oil. Medium term, we do have an upside bias, but it's too risky with the variables about the Omicron variant. What's OPEC going to do? Now, essentially, OPEC are meeting, and they're still to make their decision. They're wavering because they don't know what to do, obviously, and they're waiting for more news on the Omicron variant. Now, if the Omicron variant is seen to be, if someone says, it's fine, don't worry, the vaccine works, then expect oil to rapidly rise back up to 76, 80. It will be a buying at market opportunity. And then look at what OPEC do. So if OPEC suddenly meet and they decide to postpone production cuts, that's upside in oil, but that'll be limited until we get some kind of certainty about what's happening with the Omicron variant. So I hope you can see a theme here. It's not a market to sell because there isn't fresh reason to sell, but if the Omicron variant seems to be vaccine resistant and we have to make a new vaccine, then we would see more downside in oil in the near term. The market to keep your eye on, if you really want to get a hint of what's going on, is the VIX. I love the VIX. It's a very good short-term sentiment indicator and lets you know how traders are thinking. Now, the VIX was above 26, 28, going up to those highs. And if you notice, if you just take a look at, if we just put the S&P 500 on here, let's see, yeah, let's just put the S&P 500 on the chart. You notice, like, when the VIX rises, the S&P 500 falls, rising VIX, falling S&P 500, rising VIX, falling S&P 500. So if the VIX can keep moving lower, particularly if we can get back below 2120, then that points more upside for stocks. The stock market I'm interested in, and I am long on it. Now I recognize, look, I am being more, how can I put it? I am being speculative because I don't know whether the Omicron variant is a threat or not. My opinion is that it's not going to be a threat, but that opinion can be wrong. So I took advantage of buying back into this dip on the FTSE 100. Ultimately, I like the FTSE 100. I do like a retest back up towards that 7,500 region. Still waiting for that, that COVID-19 gap to be filled, and I still think that we're going to get there. So happy to sit and hold on the FTSE 100, moving up to 7,500. Very happy with that, and I will be, keeping my eye on that, obviously. But it's, very happy to define and limit risk there. I'm in it in cash, so it's totally unleveraged. So that means, worst comes to the worst, I can just buy and hold. So just taking advantage of those lower prices, buy the dip or buy the deeper dip. That's my perspective on the FTSE 100, but obviously it could be wrong in the near term. But my view is, you know, and as I put here in Twitter, I said, look, is this simply buy the dip or buy the even bigger dip? Whether Omicron is vaccine resistant or not is of less of importance in the long run. If it is just a question of rolling out a new vaccine, companies are confident in making a new one. And you can see here, look, Big Pharma is confident that it can make a vaccine specifically for the Omicron variant and can produce it fairly quickly. Now, you know, every man and his dog is out. You know, anyone who works in pharmaceuticals must be working at some kind of COVID-19 treatment. So as a nation with so much resource and, well, I say as a nation, as a globe with so much resource, the ability to communicate, you know, how hard would it be to get a new Omicron variant? Now, I don't know, this is not I'm not a virologist, I'm not an immunologist, but the people who are confident. That's enough for me. That's, you know, that's sort of key aspect that I'll be looking at. Okay, folks. Is there anything else of significance to share? I think that, oh, one other swing trade I do like is the Euro New Zealand dollar. I'll explain why. I like this as a swing trade. The reasoning is prices at value. Stops can be put above 1.673. I do think that the outlook, let's just put the bond yield spread in here for the German 10-year and the New Zealand 10-year. So if we just look at the bond yield spread for, the reason we use a German 10-year bond is because Europe don't have a bond. So you just use the German bond yield as a proxy. And remember that Germany is the biggest member state of the European Union. So as a consequence, you just use the German bond as a proxy. And you can see, look, you know, that's, yeah, okay. Right, you see what I mean? A bit like that New Zealand dollar yen story. Yes, you know, prices moved a lot higher, but bond yield spread hasn't. Similar to what happened here in August. You know, price rockets higher, but then that was actually a pretty decent. I remember that. Looking at that, I was looking for a false break of a trend line, looking for steady for that trend line. So this looks good, right? This does look good. And stocks can be carefully defined there. Europe struggling with surging COVID-19 cases. New Zealand, well, we've seen that the outlook is pretty rosy. Okay. Yeah, gold at a similar level to the exact. Yeah. Now, when you see markets like this, Josh, this tells you there's a lot of uncertainty, and it's this: you've got massive contradictory signals. Bullish, bearish. That's the latest one. That's bearish. And if the Fed start a hiking cycle, you'd expect the dollar to rise and gold to move lower. Remember the one chart, and you only really need one. Actually, just look up at this. Read this article. This will give you the lowdown on how to trade gold. Just check this out, guys. I just run through the intramarket analysis. You can have a look at it yourselves. Yeah, okay. Yeah, great work, folks. Good, very good opportunities could be setting up. So be alert and get ready. Could be some big shifts coming up. Folks, thank you all very much. Take care and have a really, really good rest of day. Thanks everyone, one and all, and take care now. Goodbye.